Hello and welcome to Market Domination. I'm Josh Lipton, live from our NYC headquarters. Stocks rebounding here. It's after President Trump softens his tone on China tariffs and says trade relations with China will all be fine. We're digging into that story in just a moment. Right now, there is just an hour to go until the closing bell, and stocks are ripping higher here. We got the Dow up nearly 500 points, 510 now actually. S&P 500, your broad gauge, that's up 1.4%. Your tech-heavy NASDAQ, that's up over 2% right now. Let's welcome in data and markets editor Jared Blikre. Jared, what are you seeing for the day's trade so far?
Thank you. Let's start out with the NASDAQ, which, as you said, ripping 461 points, 2%. We just came off the worst day since April, and we are having the best day since May. So go figure there. That's the NASDAQ. Let's take a look at the Dow. Very similar chart. It's been green all day, still pretty close to the highs here. Dow's up 1%, about half what the NASDAQ is, but that's good for 502 points. I'm sure investors will take that. And the S&P 500 up 90 to 1.4%. Also like to get a gauge of the small caps, which are taking a beating on Friday. They are up even more than the NASDAQ, up 2.76%, and that's one of the best days they've had in months. And as far as the bond market, well, guess what? It is a bond market holiday for indigenous peoples, so we don't need to go there. But the U.S. dollar index, meanwhile, is slightly up, about 0.3%. And taking a look at the best sectors of the day, not surprisingly, it is tech. After chip stocks got clobbered along with China on Friday, they are up and leading today. So XLK up over 2%, consumer discretionary pretty close to 2%, materials of 1.4%, and those are your outperformers. To the downside, only healthcare and staples. Those are your two red sectors, which are defensive. So all in all, a very bullish setup. And taking a look at the NASDAQ 100, some of the big outperformers today, we got that Broadcom deal. We're going to be talking about that. That is up 9%, and the other chip stocks up very nicely. But what you notice here is just a lot of green and also dark green. Look, Tesla up more than 4%, Alphabet almost 3%, and the list goes on. If you take a look at the Dow, well, you get a little bit more red because it's got some of the more defensive sectors in there, like healthcare, Procter & Gamble. I mentioned staples, Procter & Gamble down almost 2%, but for the most part, a lot of these cyclical names like Boeing, Caterpillar, each of those up more than 2%. Those are doing quite well. And another sector that was really beaten down Friday is transportation. The opposite, the flip side today, and I'm just going to cycle through tech real quickly to show you what the semiconductors are doing. Lots of dark green there. We mentioned Broadcom, Taiwan Semi also up 8%. Here's software. We're seeing Oracle up 5%, ServiceNow up 3%. And then finally, some of those smaller disruption names, a lot of those doing well too, but not quite as well as some of the mega caps. So all in all, a pretty bullish picture favoring some of those bigger names, but especially the chip names and China.
All right. Thank you, Jared. Well, investors are watching U.S. and China trade tensions very closely, but some argue the latest standoff won't break market momentum. Our next guest, Michael Kantrowitz, Piper Sandler chief investment strategist, has said don't trade the headlines, trade the cycle. Michael, always great to see you on the show. So I'm looking here. I got green all over the place today, Michael. I mean, obviously on Friday, U.S.-China trade tensions, we have the freak out. Was that just a blip, Michael? And as investors, listen, should we just look through that, past it, full steam ahead here?
Well, I would say the fundamentals of the economy remain are a tailwind for equities. Of course, it's been a while since the markets have been negatively surprised by any tariff headline news. And what we've observed is that the market not only is going to respond to news, but ultimately, whether or not the market follows through with that is ultimately if those issues come to fruition. So really right now, it's really headline news. Nothing explicit time and date has been set. If anything, we've heard obviously positive announcements from Besant and President Trump over the weekend, and it sounds like they're going to be talking. But just the recent behavior and pattern of these tariff headlines, I think, has been quite diminished. But obviously Friday was a bit of a shock in a market that's been up a lot. So I think people just maybe use it as an opportunity to take profits. But I don't think President Trump's going to do something to disrupt this bull market.
So broadly, Michael, you still constructive on this market? You're broadly in that camp that says, listen, earnings hanging in there, economy's hanging in there, and the Fed's cutting. Stay long.
Earnings look great. When we look at the breadth of earnings, small cap earnings estimates are at a 2.5-year high. It's been part of the story within that space, which is why it's lagged. The earnings estimates have been going nowhere up until about 3-4 months ago. And now you're starting to see broad-based improvement in earnings breadth, something that has severely lacked in the last 3 years. So we think that's the early signs of a major change in the economic cycle. And we expect to see, as we go into 2026, these declines in interest rates from the short end. We've seen an easing cycle for over a year. Mortgage rates are at the lowest in a long time. Still high, but they're down, and that's all we need. So we expect to see better housing data, better manufacturing activity, and a better, broader economy in 2026.
Michael, I had an economist on the show recently who said, listen, as long as this government shutdown continues, the Fed isn't getting that hard data they want. And the longer it goes on, he says the greater the odds that at this next meeting they don't cut. I'm just wondering what you make of that theory. And if they didn't cut, how you think the markets might respond.
Yeah, I'm not so sure I buy into that. There's plenty of other data besides government data that the Fed can look into every day, every week. So I'm not so sure that they're just going to not do anything just because there's a bit of an absence. I mean, there's been a trend in the labor data for now, arguably 2.5 years. But it's been very clear now in the last few months, given all the revisions we've seen to the data, plus just some soft ADP data. And obviously, when we were getting the NFP data, that data were soft as well. So I don't think the Fed wants to surprise the market. Thus far, Powell in his term really hasn't, or at least not since COVID. So I wouldn't bet that the Fed's going to pause because of an absence of information. I think they'll just take the information they have that is known and act accordingly. And I think they're probably going to cut once more. Cut in October.
What about, I want to switch gears, just talk to you about the AI theme as well, Michael. We heard today OpenAI partnering with Broadcom. They're going to work together, it sounds like, develop these 10 gigawatts of custom AI chips. AI boom, Michael? AI bubble? What are you telling clients?
I'd say it's more of a boom than a bubble. When we think of bubbles, we think of valuations going to the moon. And of course, there's a lot of froth today. Anytime you're in a market that's at all-time highs, that has seen such strong returns in the last few years, you're going to get a lot of speculation at the fringe. But the biggest companies in the market today are printing money hand over fist, which is quite a contrast from the backdrop in 99 and 2000, when the bulk of the returns in the NASDAQ and the tech sector were really coming from multiple expansion. Here's a fun fact. In the last 3 years, the S&P's multiple is up, the small cap multiple is up, but the multiple is not up, the Mag 7, it's down about 20%. So it's all been earnings driven thus far. And if we're back into a easing cycle, I can tell you from studying bubbles throughout my career and reading a lot about them throughout history, is they don't pop when you've got easing money conditions.
Let me ask you, Michael, I mentioned the government shutdown. I'm curious what you're telling clients about that. Listen, as investors, as long as we think it's not going to impact corporate earnings, should we just look through it?
Yeah, I don't see it impacting corporate earnings, nor do I think it's going to last that long where it's going to get to that point. Sure, it's not going to be a week and a half or 2 weeks, which is I think what most people thought it would be. But even if it drags on a little longer, I think looking at all the different macro issues today, that is not a big one right now for the markets. And there's really no clear transmission mechanism into markets and into corporate earnings. Certainly not right now. If this drags on, months and quarters, then maybe we can consider that. But I think it's way too early to be concerned about that issue. Finally,
Michael, I'll just get you out of here. This broadly, I'm just curious, where do you see the opportunities in the market? What are you screening for to own and to avoid?
Yeah, well, I'd say where we're most at a consensus, and this has been a theme of ours for a couple of years, that rising unemployment is a bullish catalyst for equities, and that is just not a idea that people are really think is intuitive. And obviously, it's counterintuitive to some respect, because the last two recessions of 2001 and 2007, that was quite the opposite. But actually, if you look throughout history in periods of rising unemployment, you actually see stocks go up more often than they go down. So we're seeing that the last 2.5 years. So we would be recommending areas that would be typically labeled as early cyclicals and other cyclical areas, financials, banks. I think home builders do well in a backdrop where the labor market's soft and rates stay low. Some consumer discretionary areas that have really been kind of underperforming. So, I think this is a time where the laggards can start to see some relative performance, something that's, again, been absent for the last several years. I don't think we're going to be seeing a big economic boom coming out of this, so I still think you want to be selective. But I think we're seeing a broadening into 2026. And I know people have been calling that for years. This is the first time we're making that call, and we see a lot of green shoots that support it today.
Michael, always good to see you on the show. Thank you, sir.
Yep, my pleasure. Take care.
Coming up, Broadcom, the latest company to get a bounce on OpenAI news. We're going to explain what they're working on together. Plus, President Trump and President Xi remain at an impasse, taking a deep dive into what a renewed trade war means for the economy. And Estee Lauder, that stock getting a glow up. We'll explain why that stock is moving, those stories and more when we return. OpenAI teaming up with Broadcom to co-develop up to 10 gigawatts of custom AI chips. Broadcom stock soaring nearly 10% on that news. For more on the deal, we're bringing in Yahoo Finance tech editor Dan Howley. Dan.
Yeah, Josh, this is obviously a huge deal for OpenAI. Big deal for Broadcom, probably bigger than for Broadcom than OpenAI, actually. It's not just chips, it's systems as well. So they're going to co-develop these together, likely kind of the idea of custom chips, kind of what we've talked about in the past, where something like a company along these lines comes in, looks to build their own chips and kind of wean themselves off of the likes of NVIDIA and AMD's chips. But this 10 gigawatt deal follows NVIDIA's investment in OpenAI, in which the company will get 10 gigawatts of NVIDIA chips. And oh yeah, it follows that 6 gigawatt deal they just had with AMD last week. So far, OpenAI has signed deals in just the past few weeks for 26 gigawatts of GPUs. Now, just to give you a sense of what a gigawatt works out to, that's estimated between 700,000 and 800,000 homes. So looking at kind of about 20 million homes potentially would be powered by those chips. And so this is part of the ongoing build out that OpenAI is doing. They say that they need this many chips to meet demand. They said they had about 800,000, I believe, weekly users. That's for ChatGPT. Sora 2, they say, is gaining a lot of traction among users. That's that video capability that's kind of a odd mix of social network and AI video creation. And then, obviously they have their deals with Microsoft. And so this is just part of this ongoing expansion the company is undergoing. They still haven't turned a profit, though. So we just have to wait and see when that happens still.
Let me ask you about Sam Altman. I mean, bigger picture, Dan, so he's doing these partnerships and these deals. He's locking down the chips. He's keeping those developers, the app builders excited. I mean, how is he just fully in the lead right now? Is everybody else just playing for silver?
I think so at this point, right? I mean, you look at the other companies out there, the Anthropics, the Perplexities, the Mistrals. They're all kind of playing catch up to a degree, and that doesn't necessarily mean you throw Google and Meta in there as well, but that doesn't necessarily mean that their technology is worse than OpenAI's. It's just a matter of the fact that they had first mover advantage. They had that big announcement with ChatGPT in 2022, I believe it was December 2022. Then they had the big announcements with Microsoft, where Sam Altman came out and talked about teaming up with Microsoft, with CEO Satya Nadella. And so they've managed to hold on to that lead for some time. And you think of generative AI now, and it's basically you think of OpenAI and you think of NVIDIA. And I think that that's going to continue to be the case. Obviously, the other companies would like to change that. Microsoft even looking to build out its own models and compete more directly with OpenAI despite their team ups. Google, obviously, they have Gemini. They've announced some of their own Gemini capabilities when it comes to consumer side and enterprise side. And then obviously you have the same thing with Anthropic and Mistral. But you look at where OpenAI is at this point. They're just grabbing users left and right. They have deals with Apple, where you can use ChatGPT in addition to Siri on your iPhone. And so, yeah, I mean, they're just firmly in the lead. Again, not necessarily from a technological standpoint, although all the companies kind of go back and forth as they release new models. But really, I think from just a kind of mind share standpoint.
Dan, thank you. Appreciate it. Well, which side will blink first when it comes to the standoff between Chinese President Xi and U.S. President Trump? The back and forth may stir volatility, but will tariffs alone derail growth? Michael Pierce, Oxford Economics Deputy Chief U.S. Economist, joining us now to discuss. Michael, it's great to see you. So let's talk about U.S.-China trade tensions, Michael. You saw that sparking a sell-off in the markets on Friday. Today, just look at the screens, we see relief all over the place. But I'm curious how you think about U.S.-China trade tensions through your prism as an economist, Michael. And to the extent that those tensions ratchet up and tariffs ratchet up, how do you think through, Michael, what the possible effect would be on U.S. growth, manufacturing, inflation? What do you tell clients?
Yeah, absolutely. So I think, listen, the US-China conflict and dispute over trade isn't going away. I think what we've seen over the weekend, both sides, the US side trying to take a step back from tensions and assuring that a deal will be resolved. So, you kind of have to ride this roller coaster wave of ups and downs in the tensions. We'll see if they're able to get a deal done to avert this threatened rise in tariffs that President Trump has talked about. But really, to put in context, when we're thinking about the impact of tariffs on the economy, it's worth putting some of the numbers to that. We think the average tariff rate for the US has risen this year to somewhere in the neighborhood of 15%. And if the US goes ahead and raises tariffs by 100 percentage points on China, we think that would take that closer to 20%. That's getting a lot closer back to the levels that we saw on April 2nd. Some of the market fears that we had around that point, I think, would resurface. But it's not just kind of that direct impact of tariffs and the level of tariffs. I think the other thing that particularly worries investors, and I think was driving a lot of the market action we saw over the weekend, was this sense that there's some tipping point with these tariffs where producers just go, hey, we're going to wait for this all to settle out. We're not paying those 100% plus tariffs. We're going to wait on the sidelines. And that's when you can get risks to supply chains. And that's when you get much bigger economic impacts, more disruption to domestic manufacturing, and potentially more impact on inflation as well.
Having said all that, Michael, I see, big picture, you're still calling for, it looks like you're a U.S. GDP growth of around 2.1% this year, Michael, 2.3% next year. What is sort of driving, what's explaining that resilience you see?
Yeah, absolutely. So we're pretty much on the top end of consensus for U.S. economic growth, over the rest of this year and next. And really, I think what we've seen this year is this resilience of the U.S. consumer. And we expect that to continue. I think there's a lot of fundamental strengths behind this U.S. consumer. Real incomes growth has remained relatively solid. Wage growth is running at a pretty healthy pace. And even though jobs growth has slowed, we're still seeing wage gains outpacing inflation. And we expect that to continue over the next year. The other big thing that's going on is, we're focusing very much on the impact of tariffs, the impact of uncertainty from all the trade policy announcements earlier in the year. We think we're around the peak of that negative impact on the economy, both from the drag from tariffs, but also from some of the related uncertainty that's weighed on business investment. So, I think a lot of the resilience on the business side of the economy this year has been related to AI investment. And when you take that out, I think the underbelly or the core of a lot of the rest of the business environment is looking relatively weak. As we head into next year, I think some of that tariff-related weakness is going to fade. At least some of the uncertainties is coming out. We're past the peak in terms of that. And at the same time, you've got this tax bill that was passed in July. We think a lot of those impacts will begin to feed through over the course of 2026. So really, it's this strong consumer coupled with this turnaround, particularly in non-AI related investment, that we think is going to drive the economy forward next year.
Yeah, I want to talk about that great AI spending boom that we talk about so much on this show, Michael. How important is that to the economy at this point?
Well, I think it's been quite important through a few channels. I mean, first, the direct investment in a lot of these chips has supported business investment. You know, if you strip out spending on software, spending on computer equipment and hardware, and of course, investment in data centers, overall business investment would have declined this year rather than expanded. So it's been hugely important in supporting the investment case. But I also think there's a spillover here to what we've seen on the consumer story. You know, a lot of what we've seen around the consumer has in fact been driven, I think, by the incredible strength we've seen in the equity markets. Of course, a lot of that wealth is accruing to households at the top end of the income distribution. So the top 20% of households by income, consumer spending in the US, it's that spending which has held up. And I think that clearly the optimism around AI has been a big driver of that equity bubble. So I think the risks there could go both ways for next year, because if we saw some puncturing of that optimism, I think you've got a bigger risk, not just from a pullback in their spending, but also from a knock-on impact on consumer spending as well.
I want to get you on this, Michael. On the labor market, you call this, it's interesting, a no hire, no fire labor market. Do you expect that dynamic to continue, Michael? Or what are the risks there's a shift there, that employers do start firing?
Yeah, I think, listen, there's no hire, no fire economy. I think, clearly businesses have been under pressure this year, and we've seen that through a further decline in their hiring.
I think we froze there on Michael, but appreciate his time and his insight as always. Coming up, JPMorgan, investing in crucial parts of America's future and to the tune of billions of dollars. We'll have all the details when we return. Now time for some of today's trending tickers. Yahoo Finance's Ali Canal joins me now for a look at China stocks. We'll talk some Intel, maybe a little Estee Lauder. We're going to start off with China stocks, though. Alibaba, Baidu, JD.com getting a lift as Trump tempers tariff talk toward China. Say that 10 times, Alex.
Yeah, tariff talk toward China. And this comes after that big threat that we saw over the weekend and the sell-off that happened on Friday. Now we're seeing a rebound across the board.
Trump says it's all going to be fine.
He says it's all going to be fine. He says we want to help China. We don't want to hurt China. So it seems like that softening rhetoric really sparking this risk-on rally across not only U.S. equities, but also some of those names that are exposed to the Chinese consumer, because we know that if the U.S. does implement those 100% tariffs on November 1st, like the president has threatened, that's not going to be a good thing when it comes to a lot of those Chinese consumers. Deutsche Bank out with a note saying that investors now see this as mostly negotiating tactics on both sides. So kind of a play to the Trump always chickens out, the taco trade at work. And markets are beginning to price in that possibility that as trade tensions hopefully continue to ease, we will reach some sort of a deal with China. So that is the hope. At least you're seeing that reaction with the stock prices here for names like Alibaba, JD.com. Again, these are companies that are very much exposed to the Chinese consumer.
And some of the runs they've had, massive.
Massive.
Alibaba's about 100% this year.
And that comes as the Chinese economy, too, has really turned things around with a lot of stimulus efforts. That's a big difference than what we saw last year.
For sure. Turning now to Intel. Let's look at that one, too. That stock hit with a downgrade over Bank of America, firm lowering its rating on the stock. They go from neutral to underperform. A sell on this thing. Target's 34, by the way. Stock has gone too far too fast, they say. Companies yet to lay out a discernible AI strategy. They also did cut Texas Instruments, by the way. They went to the equivalent of a sell on that one, too.
Right, so maybe that's all a sign that the AI trade could potentially be running a bit too hot here. And you're seeing Intel shares still up 2% today, despite that downgrade. And this comes as really the entire NASDAQ is up on this relief rally. But when we look at a name like Intel, Bank of America, you were just saying, Josh, too far, too fast when it comes to the share price. Analysts say that Intel still lacks a clear AI strategy and that investors are pricing in a comeback that hasn't yet materialized. Bank of America saying the company's recovery will hinge on whether it can actually deliver its next generation 18A chip and turn some of these new partnerships into real business momentum. Now, some of those partnerships include a $5 billion foundry deal with NVIDIA. We also have that investment from the U.S. government that will help fund Intel's $100 billion expansion of its U.S. chip manufacturing operations. And it does come at a time where there's growing question marks about the sustainability of the AI trade. We just got that news this morning with Broadcom, OpenAI. OpenAI also has partnerships with NVIDIA, with Microsoft. It seems like all these major AI players are funding each other's growth, and that's leading to more question marks when we talk about the potential for a bubble. Of course, earnings season, which is coming up, it's going to give us a bit of a clue whether we're even close to that bubble talk.
Yeah, so in other words, writing checks, and oh, by the way, you can use some of that money to buy my products. That's
exactly.
How that works, right?
Yes.
All right, lastly, Goldman gets bullish on Estee Lauder, upgrading that stock from neutral to buy. So Goldman are believers, Ali, saying we believe investors need evidence of sustainable top-line growth and share gains, and we believe this could happen earlier than expected. Target is 115. Most on the street, it looks like, actually have a hold. The average target per Bloomberg is actually around 96, but Goldman, they're believers now.
Yeah, believers here. Also, a story related to China. It seems like that's the connecting thread through all of these trenders today, saying that the comeback, that China sales have stabilized amid this comeback, and that travel retail is also rebounding here, which is helping Estee Lauder, saying they're incrementally more optimistic about the growth trajectory. Goldman also said that improving margins and steady demand in prestige beauty drove the re-rating in the stock. Estee Lauder, again, benefiting from those easing U.S.-China trade tensions, which did hit consumer names particularly hard late last week. And now we're seeing that rebound across various sectors, not just tech, but again, these consumer-facing companies. And when you look at beauty across the board, it's a very tough industry. You need to keep up with a lot of trends, and that is constantly changing, whether you're talking about skincare or makeup. So, a big vote of confidence here, and you're seeing that in the share price, up 6%.
Yep, nice pop. All right, thank you, Alec. Appreciate it. Well, JPMorgan betting big on America's security, pledging $10 billion to companies it says are essential to national defense and resiliency. For more, we're bringing in now Yahoo Finance banking reporter David Hollerith. David.
Yeah, Josh, so this is a part of a 10-year plan the company announced today, and effectively they're trying to invest in key industries, emerging technologies, defense, aerospace, energy. And it's part of a larger effort, which is about $1.5 trillion in terms of facilitating financing and investments. So that's a lot of things. And the big question here, too, is what would the bank have done in a 10-year span into these industries without making this announcement? And they said they had already had about $1 trillion planned. So they're kind of doubling that amount of money. And then as part of that, which is included in the $500 million, which is a part of this $1.5 trillion, they're also going to take stakes in specific companies. And primarily it's U.S. companies, but it doesn't have to be. It does have to be U.S. and allied.
I was going to ask you that, whether they were also looking overseas.
It potentially could be that way. They said the bulk right now of the companies they're considering would be U.S. companies, though.
Do we know if Jamie Dimon had any chats about this with the Trump White House? Conversations?
That's a good question. When he was asked directly about that on a call with reporters today, he said that he had not spoken to anyone in the administration about this initiative, but they do talk pretty frequently. And obviously, I think what you're getting at, too, is the fact that the elephant in the room is that this looks a lot like what the Trump administration has been doing. And Dimon did say during the call that what the administration's been doing has been a creative effort. He also pointed out, too, to his point, was that the Biden administration also had a similar industrial policy in terms of increasing that focus. So this is a 10-year program they're trying to initiate. So,
speaking of JPMorgan, earnings on deck, David. What are we looking for?
Right, yeah. So earnings starts tomorrow, and we have JPMorgan, Goldman Sachs, Citigroup and Wells Fargo, and then Bank of America and Morgan Stanley the next day. And generally, what we're going to be focusing on right out of the gate is going to be the ramp up in deal making, which has been a big story over the second part of the summer and the third quarter. Tons and tons of large deals. So we're going to want to see how much that is actually transitioned into profits for the banks. Expectations are pretty high. They are actually higher than the past 2 quarters of the year, although results for those past 2 quarters were much higher than expectations back then. So it'll be interesting to pay attention to. Also, lending with interest rate cuts hasn't seemed to have hurt the margins of any of the largest banks at this point in time too. So overall, it looks like a good quarter for the banks. The other side of this is that there have been a few specific bankruptcies, and we're going to want to pay attention to that. Big banks have a huge credit card unit, and we will be keeping an eye on that. But mainly these bankruptcies, it's been a story of these kind of odd commercial credit stories. So we're going to be paying a lot of attention to their commercial banking operations.
All right, you got a busy day ahead of you. David, thank you, sir. Appreciate it.
Absolutely.
Tesla stock bouncing back even amid trade tensions. We'll explain why the EV maker is getting a boost. Tesla shares riding higher as the EV maker is making some waves in China. Yahoo Finance's Praz Subramanian joining us now with more. Praz.
Yes, Josh, the Tesla's kind of head in China. They're posting on Weibo that Giga Shanghai is ramping up their Q4 production. You know, this is their biggest factory by volume, and Q4 is their biggest time of year for Tesla, generally speaking. And it's good to hear that they're ramping up production there because, you know, demand was potentially questioned, and so was, you know, with high competition in China for EVs, kind of a problem there. So, you know, look, this follows good, strong sales for Tesla in September. They had sales up 25% month over month. Slightly down year over year, but still better than nothing for them as they sort of, the Model YL, which is like the bigger 6-passenger 3-row Model Y came out. They might be helping them out there in China ahead of this busy period for them.
Speaking of Tesla, new buy rating apparently, Melius Research, what's going on there?
Yeah, I seen Melius Research launch covers the buy rating, $520 price target. That's pretty big premium there. They said, quote, "We see Tesla shares as a must-own. The disruptive force of AI will wreck multi-trillion-dollar industry, starting with autos." So
man, that sounds almost Dan Ives-like.
Well, they see it as a disruptive force, I guess, right? You know, speaking of Ives, you know, he sees this AI opportunity as a $1 trillion opportunity.
Absolutely.
Adam Jonas and Morgan Stanley, same deal, right? All about the AI bet with Tesla, robots, robo-taxis, AI, XAI combination. So it's all there. It's everything you want to hear if you're an investor and don't care about fundamentals.
Well, let's talk about that. I mean, it is interesting with Tesla. We were talking off camera about this. Research and buy ratings. Do fundamentals actually matter with this name?
Well, I think Melius said that it's really kind of like out the window. You can't really gauge it that way. And Dan Levy, Barclays said that, quote, that Tesla was the OG meme stock because of the fact that it doesn't trade in fundamentals, but it's also because it's so high in retail ownership. You know, you have high conviction retail owners, investors who own the stock, and don't tell them anything bad about Tesla. They believe in the cause.
So many folks who buy it, they're believers in Musk and in the vision Musk has laid out. That's what they're buying into.
Yeah, and they say, look at the past 10 years of Tesla stock, right? It's like this, right? So they say, hey, he's made me money in the past. I believe him. He's a true visionary. I think I just saw that they, the Colossus AI data center. He's calling the project macro hard as a swipe of Microsoft, right? It's going to be we're doing not just AI, but physical AI stuff too, whatever that means, hardware. So a lot going on in the world of Tesla, but yes, it's not tethered to the fundamentals.
Speaking of the Tesla earnings, aren't they on deck? When are they coming?
Yeah, next week, 22nd after the bell, we'll be here.
What are you going to be watching for on that?
You know, I think it's going to have to be, in the near term, it's going to have to be what's happening with the robotaxi rollout. Are we going to see more cities? Are they going to take away the safe drivers? Right, that's the first stage in the AI stuff, right? Because Optimus is a long way to go, right? Optimus and the AI, that sort of the embodied AI that sort of controls these objects is the next step. And I think the robotaxi Cybercab, what's the deal with Cybercab? Is that actually planned for 2026 production? Is that still on track? Apparently they're seeing the cars go around the test track, right? So it's happening, but we want to get more, like I said, future-looking stuff, not just like, oh, Q4 sales. No one really cares, right?
All right, thank you, Pras. Appreciate it. U.S. stocks bouncing back from Friday's rout after President Trump played down the escalating U.S. trade standoff with China. Yahoo Finance spoke with Interactive Brokers' Steve Sosnick on the volatility and trading strategies at play.
Part of the problem was on Friday, it was two things, sort of a confluence of two things. Number one, you had very complacent, bordering on overheated, bordering on overenthusiastic markets. And those are the ones that are most susceptible to trip up. The bull markets often die in euphoria, not from being glum. It's when they've fully ascended the wall of worry. Mm-hmm. The second problem is, I think we all thought tariffs were behind us. And then we got this, piece of news about 100% tariffs, seemingly out of nowhere, and it's like, oh gosh, not again. We're back at this, and that was psychologically a bad tandem, particularly coming on a Friday. Particularly with a lot of the world taking today off, not stock traders, but the bond market taking the day off. It all just sort of got together, and I think the key today was, would we see dip buying? Now I think it was abetted by, sort of. I'm not going to use my favorite Mexican food, but I'm going to say,
the president reassuring investors and backing off a little bit from his most heated rhetoric from Friday.
And so that gave cover for an instant rally overnight. Although it hasn't really materialized into something bigger today. I think it's more of getting back pretty much, sort of the last part of the afternoon swoon.
Yeah. Now, you pointed out in your most recent note that you were at the Greenwich Economic Forum, and as you're good at sort of framing what we're seeing in the market. So I know you have a number of different analogies for what we're seeing right now. You alluded sort of to one of them with climbing the wall of worry, like Spider-Man, which I think is one of your analogies. But what do you think really most captures the recent trading paradigm that we've seen?
The one that I was favoring was the Tokyo subway. I don't know if you've ever taken the Tokyo subway at rush hour.
I've seen videos.
I have done it many times when my son lived there, or when I lived there actually too. You think that you can't put any more people on the subway train, and yet somehow they shove a few more in. And I got the feel that to me was explaining the market as of last week. Was these trades had gotten incredibly crowded. Anything AI related. Another couple of things I threw out there was sort of nihilism, just sort of like nothing matters. It's just going to go. Doesn't matter. Just buy. It's going to go up anyway. Another one, which was a little. It does happen from time to time, and I think we were at that period. Also, another analogy I gave was a ratchet, which doesn't apply after Friday so much, but it was that we had all these little short, shallow dips, and because people were so eager to buy every dip, and understandably so, because buying the dip, regardless of what Sam showed, as a trading strategy has worked rather well. It was interesting to see that there was really basically the failure of the dip buying on Friday. So the ratchet doesn't hold so much, and I think we got off at like Shibuya Station, and a whole bunch of people got off the train on Friday.
That's for the Tokyo heads out there. I've never been. So, what's also notable to me, and it sort of goes along with this, there was a story in the Wall Street Journal today that looked at what Gen Z is doing with their money. And they're not seeing the value in the housing market, for example, in part because they're priced out because of rates. So where are they putting that money? Into the stock market, which also supports this idea of retail buying and all the rest. So does that also, maybe, I don't know if it's which one of those categories it falls into, but that would seem to support the idea of continued buying in the market.
Well, I'm the parent of two Gen Zers, and so it was interesting because one of them basically sent me a text forwarded from one of his friends, like freaking out on Friday. Like, what do we do? My advice to the Gen Zers is that is when buy and hold comes into play. Maybe you don't want to be leveraging into some of these bigger investments, but if your time horizon is 30 or 40 years, you're probably pretty good just staying the path.
Yeah.
Staying on the path. Now the problem is a lot of them have, because of sort of the disbelief in a lot of this stuff, in the traditional stuff, whereas buying a house isn't going to work for me, or how am I ever going to afford a house is a very common refrain. I think a lot of people are taking bigger shots in things like crypto. And we had, Friday was a flash crash, as I know you teased it in the top, but that was,
in crypto,
that was, we had a sort of a larger than usual garden variety sell-off in stocks. But what happened in crypto, particularly the lesser coins, was pretty nasty. But my feeling there is, what are you buying? So, again, my advice to the Gen Zers is, don't flip out every time. Don't flip out at this stuff, but make sure you're buying stuff that seems to have a long, that seems to be in it for the long haul, not just sort of a get-rich-quick scheme. And I think in recent market environments, Gen Z through baby boomers were getting a little too enamored with some, kind of buy and chase rather than buy and hold.
Right, more sort of speculative stuff. And so, you also have the opportunity to interact with a lot of institutional investors too.
Yes.
And so how would you characterize their mindset versus what you tend to see in some of the retail buyers?
I think it's almost like hold your nose and buy. I think I've said many times that MOMO and FOMO are pretty much the two big catalysts in the market right now. MOMO being momentum and FOMO, of course, fear of missing out. The institutional investors are consumed by FOMO. They can't help it, because if you're underperforming your benchmarks, that's career risk. You don't get a bonus, you get fired, you lose your mandates, all that kind of stuff. So they're in a tough position, because I think they feel that a lot of the AI enthusiasm is, perhaps a bit overdone, but they can't afford to sit on the sidelines there. I am finding that some of them are using what I would call FOMO insurance. They may be a little underinvested, but then buying calls.
Or maybe buying gold on the other side as that strategy too.
Yeah, but it depends on your mandate. If you're an equity-only portfolio manager, you can't do that. But so if you maybe don't want to be holding, all these names that are involved in increasingly circular deals, and we just learned of another one today with Broadcom and OpenAI. They're all interlocking, and so I think in some cases they may be getting a little gun shy in terms of continuing to add to these positions. So I think in some cases they're using call options to hedge the FOMO, actually.
So let me ask you this, Steve. At a time when there are so many almost structural supports for the market, these managers not wanting to underperform, younger people buying into the market instead of buying a home, for example, just generally the investment that we're seeing in the market from across age cohorts. What then causes a more significant pullback when there is so much riding on the market continuing to go up?
The fear that keeps me up at night is that we're recreating the bandwidth problems of the late 90s. And for better or worse, you and I both remember this period. And what happened was, I'm going to throw a few names at you, right? Because you needed to build bandwidth for the internet. And let me stipulate, everything that was hoped for the internet came true. Lucent, Global Crossing, Northern Telecom, Enron, WorldCom. These were the companies throwing big money at bandwidth. And while the bandwidth ended up needing to be built, and Cisco was the NVIDIA of its time, that money ended up being very poorly spent when all was said and done. And I have this nagging fear that all this data center money, all these chip promises, if OpenAI is driving them, they had $12 billion annualized revenues. Where are they coming up with $300 billion for Oracle, less some of this other stuff? So the capital needs of AI are far from done.
We're wrapping up today's Market Domination. Don't go anywhere. We've got you covered with all the action. Following the closing bell, stay tuned for Market Domination Overtime.